Welcome to the Gray Market Talk with a retired market maker for options, Thorsten Wegener, that's me, and a semi-retired portfolio manager extraordinary, Nic Themistocli. Today, we're going to talk about, is inflation real or will it disappear? What's the influence on the market about the situation, the political situation we see at the moment? And we'll also have a look into volatility. And at the end, I'm going to show you, I have no clue where markets are going, but we have low volatility trade setup. I hope you enjoy.
They're doing heavy investments, which they should, right, to keep the growth. So I think this is a buying opportunity.
Welcome to issue number 5 of the Gray Market Talk between Thorsten and Nic. Nic and Thorsten. Thorsten, the one who is a little bit more extrovert, and Nic, the guy who shoots me down and brings me to senses to not press the button just too fast in this scenario. We already had a conversation, obviously, about what we want to talk about today. And I prepared a little, I don't want to call it a slide deck. I want to call it quite interesting slides. I used to show these to my students because I get all these emails, I get all the Twitter feeds, and they're always food for thought. So we might want to circle around this, but I want to give the word to Nic first. Hello, Nic. How are you?
I'm good, thank you. Glad to be back home.
Excellent. That's what we want to hear. I was getting jealous a little bit last week, but hey, now you're back in the office like I am in the office, and let's kick off. Let me try to share my screen. Then we can actually already have the starting point. Nic, you can see the screen, then everybody else can see it as well. So, Global Inflation Watch, one of the screenshots I saw last week. What are we making out of this, Nic? US 6.9, Eurozone 6.3, UK 8.7. I think it's even lower in real terms. Is inflation dead?
It's dying. So that's probably the easiest thing to say. It's dying. We talked about this in one of the earlier videos. So, what's caused inflation? If you ask central bank officials, it's something other than the truth. And the truth is it's caused by the excessive amount of money that they've created in the system. The great Milton Friedman, inflation is always and everywhere a monetary phenomenon, and it really is. But central bankers don't, for a while now, they don't follow monetary aggregates. So the money that they created after COVID caused all of this inflation, and in different regions, it's taking a different length of time to kind of work its way out the system. But it will work its way out the system, and we'll get back down to what I would call normal levels, but perhaps not necessarily as low as what the central bankers have as a target. I think this notion of 2% is not realistic, and I think that will get adjusted at some stage.
Well, I've heard a couple of fringe opinions there as well. Obviously, mine is that inflation is not dead yet, and I'll show you in the next slide why I think that is, because I'm a little housewife and I do all the shopping, and having been a trader, I memorize prices, so I know how much shit got expensive in the markets. But the fringe opinion, I thought that was also actually very, very interesting. If inflation falls, could it turn into deflation? Richard Koo, you know him. He came up with the Japanese or the description of the lost decade in Japan of a balance sheet recession.
Yes.
Which would be the other side of the medal.
So that happens when people start to delever themselves, and who's going to delever themselves? The leverage is mainly at the sovereign level. We had leverage at the household level and the corporate level, 2008. The sovereign effectively has taken on the debt of everybody to fix the problem of 2008 and subsequently. So, if you say, is the balance sheet recession coming back in the Western world, I'd say no way, because in order to do that, you have to destroy the economy, and by that stage, they'll replace every central banker and take control. So that just, I don't think that's going to happen. So that was okay when the level of sovereign debt was very low, but this is just far too high now. Now you have to have a different game plan in order to solve this problem, and the only way out, if you like, is to keep inflation up, to if you like, inflate your debt away, and how do we say, cap the interest rate. So I'm still a big fan of some form of yield curve control, or at least some negative real yields for a while yet.
So one of my favorite writers, Ayn Rand of Atlas Shrugged, famous, and being actually the mentor to Alan Greenspan, which not a lot of people know. She once said, you can ignore reality, but you can't ignore the consequences of ignoring reality forever. And that is one of the things, obviously, as the little housewife I am, these are the UK prices. German prices look pretty much the same, but that's a slide I came across. So we have the official inflation figures, ta-da! And we have what people like when they go into the supermarket and suddenly have to pay 30, 40, 50% more for a carton of eggs or the milk they have. This is the real reality. And we've seen that in the savings rate in Germany. Saving rate goes down already from a high level. Yes, 11, 12%. We're now at 10% in Germany. We've seen the same. Again, balance sheet recession theme. We've seen the same in Japan going on, though people are deleveraging, not because they want to, but because they bloody have to. They're actually broke. And that is the next slide. That was a quick screenshot. That's why the Tagesschau, the German news, is on. And we are not a political program, but just to give an overview, I found that very, very interesting. This is from 2018, and it shows the average income of a German guy who is an average spending pattern in 2018. So he makes, on a gross basis, 4,500 euros a month. Right? This is not what he already, or what he gets as an official gross payment, because they say the employer is paying parts to your pension, to your health insurance, to your unemployment insurance, to your old people insurance. So that is getting deducted before they even see it. So they end up with 3,771. Then they have to pay their share. Very clever. Of this brings you down, and then you have the consume taxes. Once you get your money, obviously you're spending it on consumer goods. And if you don't make a lot of dosh, then, well, most of the money you have is being spent on, well, taxes for living, for food, for clothing, for insurances, for petrol, for tobacco, in my case, and other taxes. So you're already down, after these VAT taxes go on top, to 1,913. And if you reduce now all these taxes which you pay after you have already been taxed, you're being left with roughly 25% of every dollar, every euro you made. And obviously it hasn't become better since we are in the energy crisis in Europe. We see the loan and savings quote is dropping. The inflation figures are, in my opinion, showing a false figure, simply by the calculation of the basket. What is the implication of that for the market, Nick? If we really take a step back and say, what is going to happen with our economies, especially in places like Germany, still the engine of Europe, what is the path forward if we see that?
So, I mean, you showed two slides, but let's focus on this one right now, because I think that's really important. And I've said it a few times before, and I think that sort of comment from Alan Greenspan, which basically suggests that the US cannot afford for stock markets to stay stable, let alone go down. And the ultimate reason is because tax receipts are highly, highly correlated, in the US at least, to what goes on in the stock market. And I explained previously that this was partly due to what Clinton did in terms of not allowing sort of incentive payments above a certain amount. For you and me, that's a really high amount at 1 million. And instead, he did allow things like, stock payments and whatever else. But, be that as it may, the governments need your money. So the implication very simply is they will not allow a recession. they will not allow anything that, in any way jeopardizes their ability to collect money. And if people don't earn money, they don't get anything. If they don't get anything, they can't bribe you with it at the end of the day for the, to get them back into power. So ultimately, what I think this slide shows, and it's frightening, actually, I didn't realize it was so bad. I mean, I knew it was bad, but this is awful. Yeah, for the normal person in the street.
Absolutely.
After working however many years, and at the end of the day, they take from here, they take there, and if you've got anything left at the end of your life, they'll take the inheritance tax away from you as well. So I don't know if that's in these numbers at all. But bottom line is for me, governments want your money, and it's highly indebted countries. They need you to continue to pay tax, and the only way you're going to do that is if the economy grows. And I think that's a fundamental kind of part of my overall thesis, if you like, is that they have to keep the engine going.
So is that Keynesianism on steroids?
Well, it's something on steroids. I don't know. Everything is in a different way. I mean, you could argue that, but we saw the effect of all of the money pumping into the market at the time of COVID and all of the inflation that ensued. The central bankers still don't realize that was inflationary, what they did. They also still don't realize that the interest that they're paying at these very high levels is money that is creating itself inflation and inflationary. Yeah. So if they don't get that, but they need to keep the engine going, they have to do something. Now, it doesn't necessarily mean that, so there's a number of ways you could do it. You could chuck money at people and say, look, minimum wage, basic income you will earn, and we hope you can get by, and we have a minimum standard for everybody in the world. I mean, that's one thing they can do. Or they could try and grow. And, there are many things to invest in right now where economies can grow. And I mean, if you look at what Europe is, the real problem of Europe is it doesn't have energy, right? So therefore, something has to fund the transition. And, the banks don't have the balance sheet capacity, in my view, to fund the trillions that effectively are needed to turn, this world that we were living in to the world that they want us to live in the future. And that means, at the end of the day, could be government guarantees, could be all sorts of, some kind of sponsorship in some way, shape or form. But, that's what it could mean. Yeah. And, government's taken a much more active part in the destiny of the world. And that's,
Isn't that the path to socialism in here? I'm always telling my students, if you look at East Germany, which we had, and West Germany, why was there no stock market in the Eastern Bloc? We all know that the average growth rate of the S&P is give or take 7% a year on an annual basis. So what it actually does, it goes from the bottom left to the top right. I could swear money, and I've never seen a study where somebody made a fictional stock market of the Soviet Union, of the Eastern systems, where this would be absolutely from the top left to the bottom right. They would have loss rates of 3, 4, 5, or even more percent. We've seen it with the collapse of the Soviet Union. Yeah? I read this book by Gorbachev, and he said when he had his first meeting, they were talking about the shortage of pantyhose in the Soviet Union. That's when he realized that the game was up. So if we're drifting into this direction, do you have then the typical effect? Socialism always works when they start doing something short term. You have a fantastic bull run because they suddenly can do stuff. They spend money. The market reacts with a sharp burst to the upside to that till it finally realizes this is not able to be perpetuated. So I'm doing something here which I actually do not like to do. Should you buy on socialism?
So, as you say, we're not politically oriented, me and you. We're fairly neutral.
We're analyzing like economists, right?
Absolutely. And what it is blatantly clear to me is that governments are moving much more in a direction of command and control. I mean, they control the media, they control everything else. And if you think for one moment that they can allow some, let's just say, less competent central banker who's blowing it all up for them, that they will allow that to continue. So you can argue, will central banks stay independent going forward? So that's a big question mark as well. So is that socialism? Well, you can call it what you want. I just say those are the ultimate thing, that governments realize that they have to control more in order to keep the system going, because of all of the mistakes that have been made in the past. They now say, well, actually, what do? We can't just let the system fall apart. So we have to keep the system going. Frankly, that kind of makes sense, because they do not want thousands of millions of people sort of knocking on the door saying, "Oi, what's going on?"
Well, maybe we could use the euphemism and say they are drifting into a control economy to eventually end up with a command economy.
Well, they may well end up doing both sort of pretty soon. And yeah, I mean, and what implication does that all have? And that sort of comes down to, why do I think that, in spite of all of the things you talk to me about, copper and oil and China and all of this stuff, I say, don't care, right? Don't care, right? Because they can't afford it. Because at the end of the day, they just have to make sure that they get their taxes so that this thing keeps going. And if it stops going, then there will be some angry electors standing on the doorsteps, creating a different type of havoc, to an economic havoc.
Well, only in France, not in Germany, though.
They are very good at that, but in the end, this is actually a really, really important thing that everyone kind of doesn't look at when you see these charts of what happens when the Fed pauses, is because big picture. Look a few years ahead. Look at where we are in the world of debt today. That they cannot allow this thing to fall apart, because if it falls apart, God help us all. And the Chinese, how is their model? They did not, in the COVID time, they didn't chuck a load of money at people. I mean, they locked them all away. Yeah. They didn't chuck a load of money at people. They understood that they already created the bubble through the real estate thing, and they're desperately trying to create a stable environment, because 1 billion people make a lot more noise than a couple of hundred angry Frenchmen in Paris.
Yeah. No, I find this whole scenario fascinating at the moment, because if you hit the history books again, it's always when they introduce more control or command economy scenarios, stock markets at the beginning always go through the roof, to the moon. Because suddenly they realize, or the investors realize, wait a second, if you're well positioned within this economic system, you can expect a lot of government money, which will improve your profits. You have less competition there. So the opposite of the Austrian model, actually. Capital gets allocated to not the most effective guys out there, but to the most political guys out there.
Well, that's the other part of that control economy, is suddenly somebody else chooses who makes it and who doesn't. And, are you a friendly actor? Are you an unfriendly actor as far as somebody else is concerned? It's a really important thing for the future. But, again, we're talking a little bit, how does it impact markets again? Effectively, we're saying they have to continue to debase, the pound in your pocket. And what do you do? Right. So what do you actually try to protect? How do you protect yourself? Real assets, long term, you want to think about commodities. You have these precious metals. You have things like cryptocurrency. So all of these things, you have to pick the right moment where you are in on these topics, because if you just try to say, oh, because we are high, I will sell, you are missing something horribly wrong. And that's, I would say, for the people who have been bearish on Twitter and all these people that sell subscriptions to people who love to hear the kind of the bear case. It's easy to come up with a bear case. I mean, it's a bloody mess, right? That's a bear case. It's a bloody mess.
I came up with it because, well, what I've learned over the years on a trading floor, there are a couple of pointers I look at, and all these pointers look shit, right? So in lack of some superior foresight, which you have, I don't, well, I put on a trade where I think the ducks are stacked in my my direction, and let's see. I control my risk with that. But this is perfect, because what are people buying to protect themselves against well, the devaluation of their money stocks? Fantastic segue. Let's go into our favorite stock, NVDA, obviously, and I also have a fantastic conspiracy.
You don't want to talk about eggs on bread. No. I can talk about that as well, but I mean, you know, just 2 seconds on eggs and bread, because it was on your slide. Okay, The politicians see the eggs and bread story. So dear old Rishi in the UK, you know, thinks, hang on a minute, somebody's profiteering from all of this stuff, surely. And you know, if you look at you know, the sort of stock price of the distributors like say Sainsbury's or Asda in the UK, you know, their P&L, they've struggled, so they've tried to put a lid on prices, supposedly. So they say, look, we're not profiteering at all. So you go to the producers, right, and you go to the Nestle's of the world, and you say, well, let's have a look at what they're doing, and they say, well, look, we haven't made any money either. So, you know, either there's an awful lot of incompetence around where all of the producers went and bought after the Russia-Ukraine event last year. They went and loaded up on a bunch of these commodities and then said, okay, well, our in price is really expensive, so we're going to charge you that price. Since that time, of course, all of these commodities have fallen. So why aren't the prices of all of these products falling? So they will fall at the end of the day, and but partly profiteering and partly you know, this bad timing on buying your stuff.
Well, Mr. Sunak came out last week, was actually raising the topic as a conservative prime minister about price controls in supermarkets.
And you know, let me tell you another thing about price control. These guys try to price control the energy costs for the consumers. At the end of the day, the consumers today are paying more money than they would do if they stopped the price control, because, you know, the price of energy has fallen sharply, and very few people in the UK are benefiting from this thing. So that's another story about inflation. You know, the moment the government kind of gets involved, you know that something's going to go wrong. Anyway, we can move on from the egg story if you want.
It is basically because nobody ever asked them to read Thomas Sowell's basic economics book. It's so easy. Teach it in school, give it to a Mr. Sunak or whoever runs an economy, say, read that and you will understand. No, I'm with you on that. But hey, however...
It's because they're surrounded by sort of, you know, I can't really say, well, I can't say, I don't work for anyone anymore, but the central bankers that they're surrounded by keep giving them different stories. So, well, it's not our fault. We didn't do anything. It's them over there. And sadly, you know, they're getting away with it.
Absolutely. That's the break. NVDA. That used to be one of the most reliable indicators in the world. When I was a young trader, before we had internet and all these things, I still have them somewhere at home, Nick, all the title pages from the broadsheets when they were talking about markets, whether it was the Spiegel or the FAZ or the Bild Zeitung. And that was actually the main headline last week. One of my colleagues sent it to me and said, look what Bild is just feeding into the feed. Obviously, for our viewers who do not speak German, it simply tells you if you would have invested 1,000 euros in NVIDIA, you would have now 213,000 euros. And what is the next 5 hot candidates where you can do the same? So yes, fine, it's not a tabloid anymore and you can't rip it off. It's internet and internet goes fast, but I found that quite intriguing to have one of these headlines when the man on the street in Germany is being enticed to go for the next big AI story. So made me cautious a bit. What's your take
now
on
you've
this?
told the man on the street that his 4,000 a month is really 1,700 or whatever, 800 or whatever it was you showed. Are you going to tell him where to put his grand?
No, they want the remaining 1,700 grand as well, right? So give us another grand and put it in NVIDIA, and that's where my theory also comes in. That was actually the 1 trillion market cap club, where NVIDIA is now a member. And I find that actually quite intriguing. Obviously, Apple, yes, everybody loves their product. Microsoft, I love their products. Aramco, they do real stuff. Alphabet, Amazon, Meta, Tesla doing real stuff, producing cars which haven't been facelifted in over 5 years now. You know, where I was really excitingly staring at Tesla outside my house. They haven't done any facelifts to these cars. Electricity prices have gone through the roof. The quality is not comparable how a Daimler or a Merc or BMW was produced in the past. And he's giving freebies out all the time. You know where I made a killing when I saw somebody giving freebies out?
Tell me.
Peloton, you couldn't get during the pandemic, you couldn't get your hands on a Peloton bike. And it was like, you saw adverts on your Facebook feed and it said, oh yeah, you can have one for 2.5 grand and we give you 20 bucks off, 20 bucks off, right? And I thought, okay, fine. Obviously everybody wants a Peloton. That's it. Suddenly they reduced the prices to 50% discounts. Little Thorsten went short and obviously closed far too early. I made, I think through options, 150, 200%, something like that. And then it almost literally went to almost zero.
Yeah.
And when I see Tesla at the moment, how he's actually trying, because all these batteries are sitting somewhere in a graveyard and deteriorate, he has to get his stock out. And if Elon wouldn't be the CEO of Tesla, where would this stock trade?
Yes, clearly. No, I get that. I mean, there are some other sort of obvious comments on this chart, but I'll let you finish on what you want to say on this chart here.
Yeah, well, it's actually, we have now NVIDIA in the $1 trillion club. And what I found interesting, somebody, if I don't quote the sources, sometimes I don't have them. Yeah, that is not disrespect to the guys who put all the work in. I found this quite intriguing. This simply shows on the earnings calls how many S&P 500 companies quoted AI in their earnings calls. So obviously this is the last quarter where we had the quotes, 110. And we spoke about that last week. We're actually waiting, or at least I'm waiting for the companies, catfood.ai and all the other things coming out and releasing, getting into a new rally with all the specs out there, which are now investing AI. Is it possible, Nic, that we have a very selective bubble in a market which otherwise has a reasonably, let's call it reasonably fair value, and we just have this one pocket which might also correct without affecting the other parts of the market too much? Is that an idea, or am I talking rubbish?
Well, you never talk rubbish.
No, thank you very much.
But I mean, let's think back to Tesla for a moment. I remember when there was this frenzy, as there is today on NVIDIA, there was this frenzy on Tesla, and all of these Twitter chaps came out and they said, do you realize that Tesla is worth more than Toyota, BMW, Mercedes, all that? Yeah. You know, and is it zero today? No. Is it one of the most valued companies? Is Elon Musk the richest person in the world? You know, maybe these things will come true. Maybe there is too much of a frenzy. As I said, greed is fine, but if you go a little bit too much, sooner or later you're going to get hit.
I have one beautiful long-term. No, let's put it that way. That sounds more exciting. I took out a life insurance policy on Elon.
Oh, good.
Yeah. How did I do that? I just looked at the chart and thought, okay, fine. This company is where it is because this man is obviously a bloody genius. Yeah, no doubt about that. He's a good manager. He has the brain. Fantastic. I would want to have a best friend like Elon. Rich or not rich, just somebody with that brain. Fantastic. And I thought, what will happen? Obviously, I just said it. it will be a bloodbath. Yeah? The quality of the car is not the best in the world. Competition is moving up. The stock is trading where it is because of Elon Musk. So I thought, let's have a look at the option market. So I took out a long-term option position, a so-called digital. I bought a 66 put, stock price trading at where? 200, 300? I don't know. And sold a 65 put long-term against it. Profit loss ratio 10-1 when I opened the trade, which means the tiny amount of money I put in there will tenfold, and I have over 1.5 years time to put up this trade just in case something like this could happen. I thought I'm feeling very happy with it. Having something like that, obviously you can't buy a life insurance policy on Elon. Well, I haven't tried actually. So let's do it through the stock market because for these reasons. Yes, I like the guy. The guy is fantastic. Whatever he touches, he seems to be turning around into something people get excited about. Let's call it that way. Not the boring company, but still, hey, he's the one who brings satellites for the CIA into space, right?
Sure. And I don't think I have seen any of these anti-Tesla company tweets for an awful long time, because he's starting to at least deliver. Is he delivering enough to justify the stock price? You know, I'm not that kind of analyst, but
I always said jokingly to my students, Elon Musk wakes up every morning hoping that people don't realize that he's running a car company.
Brilliant guy, as you say. But I saw a tweet. I do really follow Twitter because I find it extremely amusing. And it was a tweet. Again, I apologize to the guy who put this thing out because I didn't copy his name. But he quoted, we talked about last week about some of the companies that didn't make it during the dot-com bubble. One was Sun Microsystems. I totally forgot about that one. Sun Microsystems, a friend of mine was actually working for him. And here's the quote. I'll read it. I've got it in front of me. It's long. I'm not going to sort of say all of it. Basically, it says, this is the CEO talking about Sun Microsystems 2 years after, I think, the company disappeared. 2 years ago, we were selling at 10 times revenue when we were at $64. At 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes that I can get that by my shareholders, assumes I have zero cost of goods sold, which is very hard for a computer company, assumes zero expenses, which is hard for 39,000 staff, assumes I pay no taxes, which is very hard, and assumes you pay no taxes, which is kind of illegal. And that assumes zero R&D for the next 10 years. Now, having done all of that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need transparency. You don't need footnotes. What were you thinking?
Yeah.
Now, you know, at some point, it's going to count. And it's the same thing on NVDA or Tesla or all of these companies that trade on extremely high assumptions on forward growth. They have to deliver. And the stock market is always very, very good at punishing companies that don't deliver.
Yeah.
And we'll see.
I read that as well. It's Alfonso Picadillo, actually, who that tweet went viral because he dug it out. And it is actually, you know, older guys like us with the gray hair and beard to show it. We remember all these shenanigans from Enron to Sun Microsystems to WorldCom. It happened at a phase where people simply said, I remember still on the internet side, but people were not talking about revenues anymore. You were pre-earnings, but you made revenues and it was suddenly all about eyeballs. In the last bubble, we actually were pre-revenues, pre-earnings and pre-revenues.
I remember that.
Fantastic.
Yeah.
That's the point where
it will count eventually on these companies. And therefore the CEOs are held to account to deliver now on a quarterly basis. You know, you said last quarter we're going to make 8 billion next quarter, right? Okay, deliver, and we'll see.
By the way, that's where my conspiracy theory comes in. There's a guy on the internet called the Maverick of Wall Street. A bit of a show-off name, but he's really good analyzing stuff. Also seems to be, he doesn't show his face, but he seems to have a lot of gray hair as well. And he looked into the supply chain of NVIDIA because they're actually, I didn't know that, they're not producing their own chips, they're sourcing it out, they're designing it, and said, shouldn't we find in their forecast anything which justifies this revenue increase of NVIDIA? And he said, well, it depends on if the orders that hit NVIDIA came in after the 5th of May, then obviously they are not in the supplier's books yet. So they couldn't show for that. And I thought, okay, sensible. Last week I mentioned to you, I can't believe that they just made it up, because they have the numbers there. They have 1.5 months of figures in front of them. They probably know what they're going to earn. And that's where my conspiracy theory comes in, which ties up nicely what we started with, a command and control economy. Who could give a huge order for data centers without it hitting the markets? The government. Yeah. And we've seen these stocks which are in cybersecurity and controlling the flow of information on the internet having an enormous leap. So I thought, that went through my head, oh, maybe the NSA or whoever gave a nice big order to NVIDIA. They said, okay, great, let's take it. And it hasn't shown up in the figures yet. And then it will filter through. One big bulk. That would be an explanation for this huge revenue target we had in there. As I said, my conspiracy theory.
Sounds good.
Yeah, sounds plausible.
Absolutely.
Good, fine. So, because this is Matteo Lombardo. Apparently, I'm a follower on Twitter. I follow a lot of people for whatever reasons, but I thought this chart was just absolutely amazing. What you have here is obviously the monster stocks we just had here, the billionaires, trillionaires. Then we have the S&P plus 10%. And then we have the 493 S&P companies, which made exactly a 1% return year on year.
Okay, may I comment on this?
Yes, please.
Matteo is obviously a smart guy. He's a CFA, so therefore that's fine. But I think, you know, as always, these charts do miss a lot of detail in that sort of analysis. Are we surprised? Is this something that is unique to this circumstance? And there's a chap who goes by the name of Bessenbinder, right? And he analyzed, and this is from the work of Phil Anderson, who I follow, who studies cycles. And Bessenbinder did an analysis of stocks from the time 1926 to 2016. So it's 90 odd years of analysis of you know, who makes what. And in that time, he effectively found out that actually, you know what, 4% of the 25,000 companies that he analyzed were responsible for the 35 trillion in wealth that was created in that time. Yeah. So 4% of those, because that's 1,000 companies. So what do the other 96% do? Nothing. Net, they deliver nothing. But obviously in that nothing is a net's net. So there are a lot of people who make money in that 96%, but who aren't as big as the large companies. And there are a lot of people who lose money. And that means that, you know, to make money in stocks, you know, if you look at this chart, it's basically saying to you, oh, look, see that line at the bottom, nobody's making any money. It's only NVIDIA and these other guys. So this thing is going to fall apart. Actually, what it says is that they're hidden in that plus 10%, whatever it is for the S&P, or the 1%, remaining 1%, are companies who are making a lot of money. And this is why it's important to understand trends, momentum, but also, you know, on the other side, that's people like me, and people with the other kind of skill is your man in Hong Kong, Anand, who can pick these very good companies. And but it's not a new phenomenon. And I'm just reading Bessenbinder's latest study for the time 1990 to 2010, I think it is, or 2020, I'm not sure, and gives you exactly the same kind of feedback. So what you're seeing is not new, and they make great stories, great narratives for people who want to see a bear story, but go and do your homework, and you'll find out that this is a phenomenon which is very, very consistent with what's happened in the past. Sorry, Thorsten.
Nic, you're one of the best macro guys I know. How does that, what we see in front of the screen of us right now, yeah, Meta, Amazon, Apple, Microsoft, Google, Tesla, NVDA, plus 44% at the beginning of the year. If you would have invested according to a quad model, that wouldn't have been the shit you were invested in, right?
No, of course not. And that's why you've got to think about, your models. And we talked about these models in isolation. They are useful as a guide, but they still don't tell you the whole story. And that's why, there's some highly professional guys who play those quad models. But we know them, probably don't need to name them, but I will. I mean, Hedge are very, very good at what they do.
Macro 42,
and they combine their quad model where they've been totally wrong on their quad model. But what they're very good at is actually saying, well, they have their own trend analysis similar to me, where they say, okay, this one's not working at the moment, that one's not working at the moment. They've also got some very good analysts, and their analysts, I don't need to speak for them. They do a very good job themselves. But this is not a quad model output, in my view. This is something that is very typical for those people who have studied stock markets for the history of stock markets. The big companies are these mega caps are the places where the money goes. And that's, history has proven that the top companies, ultimately see the biggest move on the whole. And if you're fortunate enough or clever enough to find those small caps that, totally outdo these large companies, but you don't see them here because the S&P 500 is a market cap weighted index. And as a market cap weighted index, the other companies are really small out there. They're probably making 200% or 300%. And it's the kind of skill or luck to find the right type of company to invest in for the right length of time, right?
Yeah. That is actually, you made a perfect segue again to the next slide, which scared the bejesus out of me. And I actually checked that on my own charting software. Yes, it's true. What we see here is the NASDAQ 100 divided by the Russell 2000. You see the spike here on the left side?
Yes.
We all know what that is. That is when we were already cutting our teeth in the second or third rodeo we had. We are here now at this level.
Yes. So
we have all the little small cappies you were talking about. Nobody wants to touch with a barge pole.
Yes, I mean, I'm following small caps. One, because I actually I quite like them for different reasons, and obviously not as a result of this chart. But if you look at what's happening in this chart, yes, at the last bubble, 2000, we had that big .com sell-off. Therefore, small caps outperformed the large caps in NASDAQ. But since the time when the Fed had started to throw money into the system and debase their currency, what has happened? It's very good for financial assets. When you put money into the financial system, you're not going to go and buy some small cap. The money will just all flow into these mega caps, and therefore, you see this strong outperformance of mega caps. I looked at. I'm following very closely the IWM and the Russell 2000 index, and I was a bit sort of, frustrated, as it were, that the Russell isn't doing anything. But if you have a look at last week's numbers, I know it's only 1 week. It's always a good sign when you see 1 week. But you actually saw the small caps outperform the NASDAQ stocks last week. And we're not far away from the point where I would say the Russell is actually, a place where you should start to put some money in at these levels. Versus the other indices, but we are very, very close to that. And Friday's price action kind of supports the technical analysis that I have right now on the Russell. I'm looking for an explosion on the upside for the Russell, but it's still got a little bit more to go to kind of confirm that. But I guess it's scary, but that's what happens when you print money.
it asks for a nice spread trade here, without any doubt.
It does, doesn't it? It does. And you know, this is your insurance trade on Tesla. Is another way of doing it, is to say, okay, I'll put on a spread trade.
Yeah, no, I'm absolutely with you, which is actually quite interesting. You mentioned volatility. I'll come to that in a second. No, let's go to the volatility first. We can do this. What is this magic chart I produced here? What sorcery is that? It is actually inspired by the Count of Sesame Street. Yeah, I was trying to solve volatility in markets by having Fourier transformation and really solving equity markets. That didn't work. So I fell back to, well, let's just count bloody days. What I have here in front of me. I looked at the VIX 21 trading days from now on, yeah, at every point in time. Let's say it's the first, and then I look 21 days in the future. Was the VIX 50% higher than the observation period before? Yes or no? And how long did that take until it was eventually higher? So what you see here is the VIX did not exaggerate or double in made 50% in price. If we would start at 10, then I only would say this is stopping this count upwards if we are a month later above 15%. Yeah, this is 50% here. So what we can see here now, that's a little bit of my traffic light system. A 50% volatility event counted in 1 month terms, or 21 trading days. On average, we have 162 days that it can go up before something happens. The median is lower, it's 90 days. And at the moment, we are at 260 days with at least not having seen a 50% volatility event in this chart. So seeing what the markets are doing at the moment, yes, obviously, that's why we are trading at the levels we're trading. People are getting more bullish. Volatility comes down. If volatility comes down, they can invest more money. That is perpetuating this circle again. However, when I see something like this, I'm inclined to expose myself a little bit to volatility. I did this obviously also for a 100% volatility event, which makes it even more obvious. So now I simply assumed a month from now on, has volatility doubled, yes or no, for all cases. So at the moment, we are at 802 days without a volatility event. Average is 474 days, and the medium is 344 days. If that would consider now, yeah, this blue line on the right side would stop and go down to 0 again, if the market now doubles from 15, where we are at the moment, to 30. Yeah? So my count at the moment says, statistically, if I take this into consideration, there's a higher probability that we see a spike in volatility than not. We've talked all about the reasons, about my bear case scenario I have here, which thinks, yeah, something is not quite right in this system, what I have. Volatility is going extremely low again. People are already talking about a volatility crash. If you look at the chart, you might assume that is actually true. Yeah, we are now below 15 in the VIX we've seen, and all the issues I've raised are not really solved. What we're seeing here, inverted yield curve, economic indicators, everything looks a bit dodgy. So I came up with an idea for a trade. Let's look at the S&P, the future here again. What have I got here? Obviously, you see a trend channel going down, and now we have broken this to the upside, closing on Friday, which is actually a bullish signal if that happens. What is this magic thing? It's simply the volume. Yeah, you can see here there's a big volume chart in the middle that is simply 1 standard deviation. Most of the stuff gets traded within this 1 standard deviation. And when did I start? I started at the, what do we call it, a low before we made the top, and then we broke this low here. So that is the confirmation that we have been in a bear market. Market went down. So simply have to start somewhere. The blue line is called the point of control, where the majority of the volume takes place. And here the 1 standard deviation pops in at around 4,300, which is also the temporary high we have seen in, what was that, July, August last year. It's too small, I can't really see it. So what kind of trade would you put on in a scenario like this? And I want to give credit to Mr. Gundlach. I always call it Gundlach's choice. It's a trade on the TLT. we made a couple of years ago, and he introduced it because he incorporated volatility. So what did I do? I thought, yes, it's very unlikely that in September we will be trading at 4,280. That was closing prices from Friday. So what did I do? I simply bought a straddle, or I'm planning to buy a straddle. That's the analysis. What is that? I simply buy an at-the-money call and at-the-money put, which will expire in September. This cost me at the moment $261. That's roughly 6% of in premium, where the price is now, at a volatility of 15. Average volatility in the VIX is 19, median volatility long-term is 17. And if you're below 15, you're already in the 40% percentile, which means 40% of all occurrences happened below 15. If you go to 12, you are at 10% only, and then you're very fast approaching the 5%. So the analysis I do not have on this sheet. That is, by the way, how it optically would look like. What is the assumption behind it? If the market starts rallying, volatility will most likely fall even further. What are the chart levels we have just seen? If we break through the 4.3, then 4.6 is very likely that this could happen. So you will make money on the delta of this position. It walks in your direction. You'll lose money on the volatility because you're Vega long, but you'll make an overall profit. If the market doesn't manage to get through this hurdle, it will most likely test the downside. When we go down, volatility goes up. You'll make money there as well, and you'll make money on your delta to the downside. For this pleasure, obviously, you will have to pay premium, time value. Every day this position loses a little money. With all the calculations I made, I took volatility up and down and went to the certain levels we had in there. At the moment, it looks at it should be bloody impossible not to make money out of this trade, assuming that we are not dying in grace here. At this level we are trading at the moment, and go sideways with a declining volatility. I think I'm going to put that on, Nic, because this market, you have a more positive, I don't want to call it bullish, but a more positive view than I have. The market is at the moment, or for the last couple of weeks and months, supporting your idea, what is going to happen. I really don't know. I just know something is wrong. Either I'm completely wrong and we see a huge crack up, then I'll make money with this thing, because volatility will barely go below 10. That's almost impossible. I think even if markets start rallying, volatility will increase again, because there will be a need for insurance policies. If the market goes down, volatility has to increase because people have to start hedging. So taking these two things into the equation, I think we have a nice trade set up until September. Also seasonalities, June is a shit month. So let's see what will happen there. What's your professional opinion on something like that?
I think that's a very good approach, because frankly, 5% down from this market, you're in the money, or just about in the money at least, is quite plausible, frankly. It doesn't sort of take away from the bull case, doesn't take away from new highs. So protecting yourself on something like that, this is probably a really sensible way to do it.
Yep. So no, thank you, Mr. Gundlach. Sometimes you need some seasoned professional to open your eyes. He played it on the TLT, same scenario. Yeah, he said, I can't say what's happening. I know. I think at the time he said, I believe interest rates will go up first and then they will go down again. And volatility is so cheap that whatever happens, I might be able to make money on the volatility, and I might be able then, if I then execute or get rid of one leg, make even more money on the other side. And I think it worked out perfectly. Obviously, portfolio theory, don't do it with all your money, but that is one of the nice little things, I think, which make a lot of sense at the moment when you can't really read the markets, because all my traditional framework somehow seems to be gone out of the window. The market is not doing what I assumed it would do until now.
Yes.
Good, lovely. Any last words from your side, Nic? I don't know how long we talked today.
We talked about an hour, but I will say two things, because there were some comments on the YouTube for me to clarify something, which I will do so very quickly, because we are at a time. Broadly, I think I mentioned two things, one about Japan and the other thing was on XLE ETF. So somebody asked what the other sort of suggestion was, as it were, or the thought process was. So I said two things. One, I like Japan, I like Japanese stock market, and I like the yen. The yen was very close to confirming. It hadn't confirmed at that stage. It still hasn't confirmed. It's moved in the way that I expect it to move, but it's not moved enough to confirm. So that one, we have to wait and see whether the currency is going to continue to go in the right direction in order to trigger the trend signal, which is what I would be looking at for the confirmation. On the XLE, which is the oil, the energy ETF, exactly the same thing. Frankly, the macro outlook in the short term is sort of very negative for energy. We've just had OPEC. I think whilst we were talking, Saudi have agreed some voluntary cuts. You know, this, I guess this is to allow the Russians to continue to sell some and fund their efforts without destroying the oil price. So they want to stabilize the oil price, but it doesn't stabilize, doesn't mean it goes up. And again, still the XLE did move up during the week, but it still hasn't moved enough to trigger a bullish thing. We'll talk about some other sort of ideas for next week.
Well, I think it's, as I said, I find it extremely difficult at the moment, and obviously markets are always difficult in advance to make your forecast, but this is something where usually you can actually sit quite snugly like a spider in its web and do what you know how to do it. This is again one of these points where I think, fine, thank God I'm trading options. At least I know how to manipulate my risk and my P&L in a positive way, have it under control. Thank you very much for this conversation, Nic. You opened my eyes again. I think we're closing in on what is going to happen, and after it happened, we'll make fantastic predictions. Why it happened. Obviously, we have a couple of viewers already who really go through the whole hour, and I hope with the last trade I could show some inspiration how to approach this conundrum we're in at the moment. And I'm really looking forward to next week. Maybe we'll even can come up with what the catalyst could be in this whole scenario. Thank you very much.
To finish today.
You're back home again. Lovely. And we go now on the after show. I'll get the booze out and say thank you to all our viewers. Bye-bye. See you soon.
Bye-bye. Thank you.